Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of Thor Financial Technologies and Portfolio Manager of THLV, the Thor Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker. I'm Brad Roth, episode 1, Tommy Mancuso of the BAD Investment Company. Yes, you've heard that correctly. He runs the ETF with ticker BAD, betting, alcohol, and drugs. Tommy and I have a great conversation. We talked for about 40 minutes about his company, how he got it started, how he thinks about marketing. We talk about the ETF in depth and the ETF strategy. And so I really think you are going to enjoy this conversation with Tommy, CEO of the BAD Investment Company. Hey, Tommy, welcome to the show. Thanks for joining me here on Behind the Ticker.
Hey, Brad. Thanks. I appreciate you having me on here. I'm looking forward to the conversation.
Well, you're actually going to, you're the inaugural episode. So the first episode out, and you're fortunate enough, I guess, to be first.
There we go. Hey, we wouldn't want it any other way, especially with the bad mentality here.
I know. I'm super excited for this conversation. I think when we first talked, I was really excited to hear about your story, your background, and kind of how you came up with the idea. So why don't we do that, Tommy? Why don't you tell me about your background and how you kind of got into this position that you're in today?
Yeah, absolutely. So I guess we'll start from the beginning, which was in college. I started working at a mutual fund shop out in San Diego, and then progressed and got all my securities license, started working at Merrill Lynch on the wealth management side, realized the wirehouse world was maybe not necessarily for me. So I joined a firm, Prime Capital Investment Advisors, in about 2016. And, me, I'm a little bit younger to be an advisor in that world. I'm 31 right now. So I started doing this when I was 22, but it allowed me to kind of think differently when we look at the advisor world. And see this whole world of technology and innovation, right? When I'm out trying to get friends to invest in a personal account and have me manage it, like, well, I'll just go on my Robinhood account. I'll go on my Schwab. Right. I'll kind of put in some default factors, kind of skip that. Now, there's a big red flag that happens, right? People can't do everything on their own. A lot of people work in different industries. As you and I both know, you got to live and breathe the financial world. So let's fast forward to 2020. Pandemic hits. Yeah. A lot of stocks, crazy things are happening in that world. We saw the evolution of the meme stocks kind of happen. And I started thinking, I go, wow, people are definitely going to struggle a little bit here. They're going to get beat at some point. As fun and exciting as it is, this isn't good for the long run. On top of that, right, we also had this world of ESG kind of colliding with us to some extent. So I kind of thought how can I make an investment product that is unique, that's going to appeal, it's going to hopefully protect investors, or at least have a long-term sustainable investment outlook or sustainable growth. And so I kind of came up with the acronym originally BAD, B-A-D. And I rattled off betting, alcohol, and drugs. And I go, okay, there's something here, actually. So I went on to Morningstar and Bloomberg, and I kind of made a quick sample portfolio, back tested it a little bit, and I go, wow, this actually isn't that bad. No pun intended or anything. So then I went down the rabbit hole, right? I thought, okay, this has brand appeal. Right. There is a counterculture, and people have been pushed in this ESG box. They're getting beat up by meme stocks. I want to create a fun product that may sound gimmicky, but actually has true value in there. So, let's fast forward, went down, the rabbit hole, talked to a lot of service providers, spoke to a lot of investors, said, do you see a spot for this? Would this succeed? And it got really good feedback. Not too many people, turned it down. They said, yeah, but you're going to cut off half of the population. I go, that's all right. We're not for everyone. And we intend to keep it that way. So, we kind of got it all launched. It took a lot of hard work, I would say, in the early innings. And then we got our initial launch in December 2021. What a time to launch at.
We weren't far behind you. So, yeah.
So, what happened there was just a slow, kind of slow bleed here. But that's when also I think a lot of retail investors to some extent got exposed in their portfolios.
Yeah.
And, as BAD was down last year, but we did, at least beat the S&P 500 by a couple percentage and destroyed the NASDAQ. Right. So those are decent benchmarks to have something in a challenging year, have a little bit of success there. So right now, we're started year one at the beginning of 2023, still, a lot of headwinds in here. The betting, alcohol, and drug ETF is essentially made up of, your largest gaming and casino stocks, your largest alcohol companies, you're drinking some booze at a baseball game, it's probably in our portfolio. And then the drug side, which is interesting, is actually biotechs, pharmaceuticals, and a little bit of cannabis.
Right.
So, that's just a little bit of a different portfolio, we like to think. It's got a lot of different, I'd say, features to it where, it's a value play, right? People shun away from some of the gambling, alcohol, and cannabis side. There's a growth play in there with legalization and expansion across a lot of those industries. And then, defensive as well, right? A lot of these things are consumer staples by nature. So right now, we're in the early innings. Launching this fund. We hope to, continue to grow assets, but that is the Cliff Note version, I would say, of how we got to where we're at.
Yeah. And you answered a lot of my questions there. And it's funny, you and I have a similar path. I actually, I started my career in family office and then I went to Merrill and I said the same thing. I was like, no offense to anybody listening from Merrill Lynch, but it just wasn't for me. And I went independent as fast as possible and got here. So I can definitely, assimilate with your story and your path. So what do you like to do outside of the office? Like, what is Tommy doing when he's not, investing in alcohol and drugs?
I'm doing a lot of market research. No, I'm kidding. A lot of times I'm a very social guy, as you could probably imagine, right?
Yeah.
To kind of have the boldness of this. So, big concert guy, big sports guy. Hometown's Kansas City. Had the opportunity to go to the Super Bowl. So sorry to anyone from Philly on that one. But yeah, I like to, I kind of have a work hard and, honestly play hard mentality at the end of the day. But obviously there's the fine line of professionalism and, being too much of a screwball by any means.
That's awesome. Yeah. You guys have had some luck and some good years here for Kansas City. So I don't think too many bad years are coming. And as long as you have Patrick Mahomes.
I agree. Maybe if we can keep his brother out of the news, that would be ideal.
Probably a good idea. Or off TikTok.
Yeah.
So you kind of answered, I really want to know what made you start the BAD company. You hit that perfectly. And, we'll talk a little bit about the ESG and anti-ESG kind of landscape. But does your firm do anything other than, manage a single issue ETF at this time?
Yeah. Right now, we obviously do have some growth plans out there. Right now, BAD is our marquee or our staple ETF. We're bouncing around a couple of different ideas right now. Not all of them are necessarily in the BAD category. But what we do like to focus on is, hard assets, core businesses that have cash flow, things that are going to be around the next 100 years, just like betting, alcohol, and drugs have been around the past. Hell, you could go back to the Roman Empire when people were partaking in a lot of these things. So we like to focus on things that have cash flow, people are going to utilize. There's a place in this world for. A lot of companies, I'd say have come up and go away, right? We've seen, tech companies spark up and disappear, right? Because they lose that fad or the new technology comes up. So when we think about sustainability, I'm thinking, what are people going to need 20 years from now, 5 years from now, 100 years from now? How are they going to entertain themselves? How are they going to get, next door, right? So it's just some of those ideas I think are where we want to focus on. And, ultimately, I think that where we want to be is kind of the go-to safe, defensive type of portfolio, but also bring a little bit of excitement in there and creativity.
Well, you're going to have a hard time picking the next ticker after, having maybe one of, if not the best ticker on the street at this point. So you're going to have to put a lot of thought into that.
I am shocked that it was available when we went to submit that. I go, no one took BAD.
Yeah.
I go, really? I was thinking like Bad Boy Motors. I was like, the BAD, whatever it may be, because it's got appeal to it, right? The name sticks out. It jumps at you. You obviously want to know what the hell is that right away. So it's definitely a great ticker, and we've reserved a couple of other ones that we have in mind here. So we'll see what happens.
Yeah,
got to make sure we can get away with them. So it'll be good.
That's great. I should get my any future plans I have. I should get out there and start reserving tickers like people did back in the early 2000s with buying domain names and then flipping them. I probably reserved them good.
It's real bizarre actually. I thought that too. You can't actually sell a ticker to anyone. Can't. No, now it's bizarre. I thought you could too, but you've gotta have some kind of deal, because I did ask that.
Yeah. True entrepreneur, Tommy. That's exactly how we think is, can I make a business out of buying tickers?
Yes. Yeah.
So you touched on it a little bit. Let's dive a little bit deeper into the investment strategy of BAD. Get it from a high level. So how are you screening? How are you running kind of the portfolio in terms of weighting? Let's talk about the rebalance structure. Like, let's really dive into the underlying strategy.
Yeah. So we'll start off with the betting category, the B and BAD. So it's primarily, we built an index essentially with a good partner of ours, EQM Indexes, and it was kind of based off of that sample portfolio that originally created, and where we focused on what's going to give us the biggest and best companies in that area. So it's primarily based off of market cap. Now, I wouldn't say we have discretion, but if a certain company and certain things don't seem right, we do have the flexibility to kind of remove them, make a couple of minor adjustments. So market cap is going to be above at least $1 billion. They got to have a certain PE and all and stuff of that nature on the gaming side. So again, betting is going to be your Wynn, MGM, DraftKings, Penn Gaming. A lot of those names you see on the side of buildings in Las Vegas and on your mobile devices if you're gambling a little bit on the side.
Yeah.
The alcohol. So that is going to be, your Diageos, your InBev, Constellation. Again, those big names that you're seeing at every ballpark and concert venue that you potentially go to. And then again, and I'll kind of talk about here the allocation of everything. The drugs is going to be, pharmaceuticals and biotechs. And those are going to be your Modernas, your J&Js, your Pfizers, a lot of those Eli Lilly, who's been on a hell of a run here lately. And then, the cannabis side, just got 3 holdings in there right now. And that is, again, your Canopy, Tilray, all Canadian based that trade as ADRs in the exchange. So the breakdown of that, though, is a 33.3% weighting in each of the betting, alcohol, and drugs. Now, the one caveat is that the alcohol side of things is only 23.3%. Because we peeled back the 10% and gave that allocation to cannabis.
Okay.
And that's because when we evaluated the portfolio there and some of the positions, there's not that many great alcohol companies, right? There's about 10 that everyone knows of on that side of things. On the flip side, there's a lot of great pharmaceutical and biotech companies, which we didn't want to pull back from those or take away. So that essentially created, 33.3 in betting, 23.3% in alcohol, 33.3% in pharmaceuticals and biotechs, and then 10% in cannabis.
Got it.
So the way it works then is we have a quarterly rebalance. We're not trying to get too cute. We think investors get very cute when they try and get too creative or they try and chase, companies or anything like that. So we have a quarterly rebalance where we evaluate the market caps, do just a deep dive, see kind of what the outlook of them all are. And then we make a couple of replacements. So there's about 54 positions in it right now. That's fluctuated. We've been as high as 57. We've been as low as maybe 52 or so in our, in the first 5-6 quarters that we've been running this. And, you maybe see a change of 1 or 2 funds or companies in there on a regular index rebalance that we have.
Got it. So if I'm understanding, you're in those buckets, right? Let's just take betting gets 33% allocation. So are your market cap weighting within that 33%? Is that how you're building and designing the index?
Yeah. So, if there's 10 companies or so in there, 3.3% in the betting in each one of those companies.
Okay. So you're going to equal weight inside of betting.
Equal weight.
All right. So you're running inside of each sleeve, whether it be betting, alcohol, drug, or cannabis, each one of those companies are then run equal weight.
Yeah.
Okay.
Yeah, correct.
Makes a ton of sense. Makes a ton of sense. And so when you were designing this index, it sounds like from the beginning of our conversation, it sounded to me as if you had the idea for the ETF before you actually ran the index. And so when you ran the index, you were trying to build, can we call it anti-ESG? Is that fair?
It is fair. It is probably the roots of the idea. Now, I'm not going to say we hate ESG by any means. There's a place for it. But at the end of the day, we don't think social stigma should be a factor when it comes to investing. At the end of the day, we are investing to make money. And I think some people, when they, put these ESG scores, are misleading investors to some extent, right? Like maybe if people are trying to go green, which is perfectly fine, I think people should focus on that. But when you're trying to greenwash some stuff, when you're trying to, manipulate the scoring criteria so you can attract a certain side and kind of put a little bit of a mask on, that's the issue I see with ESG, is the lack of transparency to some extent.
And I think, ESG had its run, I believe, in, 2021 and even in, 2000, I believe in 2020, like the latter part of 2020, like it was consistently outperforming the S&P. And it was really, to me, and again, could be wrong, it seemed like the flows were coming just because people wanted to do, the right thing. And they did get a lot of flows. And I think some of those biases or things that you had mentioned, people are starting to look into a little bit, and you're starting to see some outflows in the ESG arena.
Exactly. Yeah. And a lot of that outperformance was because ESG, a lot of the social and governance stuff is in the tech world. We know what happened in 2020, right? Tech boomed, right? As you know, that was the first round of cutoffs where people that had some of those, we'll say the woke department, let's just call it what it was. But again, I'm all good with that. And, the prior years before that, they did struggle and underperform major indexes. And then you see all these companies starting to pop up in there, right? You see Exxon's popping up and showing in there, right? And if people really knew what behind the curtain, what they're investing in, right? Where they're like, I don't want to invest in oil and gas, but I like this ESG fund. Well, look at the holdings, because there is oil and gas in there, because, okay, they're maybe not from the environmental side checking the box, but on the social and governance side, they are checking the box there. So that's, again, manipulating the system to some extent.
So when I think about, aside from it having kind of an anti-ESG undertone, it seems as though this portfolio is building more of a recession-proof type portfolio and could be valuable for an investor to, have in their portfolio currently in times like this, right? And just as, I don't want to call it a hedge, it's not a hedge, but to be able to have that kind of anti-recessionary basket inside of their portfolio.
Yeah, 100%, right? At the end of the day, people are going to gamble, right? In some cases, in recessions, more. Whether that's good for them or bad, I hope they win.
Right. Oftentimes we don't.
Yes, I know that too well. On the alcohol side, people are going to continue to drink, right? That's been a standard situation in case, again, sometimes in recessions, more often than not, they do.
Yep.
Some of the disruptions we've had since we launched, right? There's a couple supply chain issues, but, we've seen a couple of earnings here lately in the alcohol companies, and they're starting to get that figured out. And a lot of these smaller companies that they lost a lot of market share to, they're being able to acquire them at a discounted price because these, microbreweries or micro ready to drinks don't have the scalability to withstand this type of environment.
Sure.
So again, that's going to benefit the bigger players, which is why we wanted to focus on that. And in, the case of drugs, again, people are going to continue to get sick. In some cases, again, more often in during top periods of financial stress. So it is a little bit, nothing is recession proof, but we do have some recession resistant characteristics in the portfolio. And, as much as we've seen tech kind of run up here in the first half of the year, entering a recession, we think we will, have a little bit of a catch up here. We've lagged early off started this year because primarily due to biotechs and cannabis has been brought down drastically with a lot of the mid-regional banks, right? Because they can't bank with the big boys or anything like that. So that's impacted them pretty drastically. And, again, we think they're going to be around and, continue to, there will be a turnaround. So it's a little bit of a hedge, right? We're kind of hedging both sides of that coin too, because we do want to give investors growth.
Yeah.
And the nice thing about that is our growth is due to legalization, not innovation, which can take time, right? Look at the gambling space where we're seeing, is it 26 states now where there's some form of gambling, I believe, legal, and then cannabis following a similar path there, going through growing pains. That's perfectly fine. But in the long run, right, these are things that are going to benefit these industries for the years to come. And it's only going to get better, right? They're just market space is growing. And that's the areas we want to be in.
Yeah. Super interesting. I can see this being, and I'll ask you this later, but really as a placeholder in a portfolio, almost peeling from kind of maybe large cap value exposure if someone's kind of sitting in large cap that's kind of fit that tilt?
Definitely. I would say large cap value is definitely one of where we would fit in a portfolio at the end of the day, right? I wouldn't say we would, we do have some growth characteristics, I think, too, which makes us a little bit unique. But yeah, large cap value is essentially our portfolio, right?
Yeah. So let's talk about the mechanics of getting BAD to market, right? How long did it take you, start to finish, to get listed and have your first trade?
Yeah, the idea came. I would say the idea, as I kind of mentioned earlier, started a little bit before 2020 when I saw the ESG stuff happening. And then when I saw this craze of investing world and the power of the retail investor, that's when I went down the rabbit hole of how can I launch a fund that has this. I actually went to my wealth management firm and asked them, I go, okay, I know we have some ESG portfolios. I go, but how many people are utilizing those at this time? And I'll just say it wasn't very many. I go, we should do the opposite.
Yeah.
And that was great. But they're like, hey, Tommy, we like your creativity, but there's some reputation risk, right? Not everyone is thinking like you. Not everyone's thinking like your clients either. So yeah, that's okay. Great idea. But, look somewhere else. So I go, okay, how can you launch this? I was like, mutual fund, would that be an idea to do it in? And then, I was like, no one's really using mutual funds. ETFs have taken over. So I put out some feelers to some people, what do they call them? White label ETF companies.
Yep.
There was a guy out in San Diego who I met with who'd been in the space for a while. I kind of ran him through the idea and he kind of gave me a playbook. And his name's Ryan. Ryan, I won't give his full name. And me and him still keep in touch. And he goes, this is who you should talk to. This is who you should talk to. And I kind of bootstrapped that approach and kept going down that rabbit hole. Talked to a couple different white label ETF providers, talked to a couple different broker dealer providers that kind of play in that space. Talked to our index. How do I create this index so we can use some of the back testing and backdating? So that way we're not trying to reinvent the wheel. So we're kind of following a rules-based approach, which I think in the long run is the better strategy. And so then it came down to, okay, I've got this built. How do I raise the assets for it? Obviously, I put in a large chunk of my my net worth into this deal as well. And then I found about 4 or 5 different partners that liked the idea, were able to kind of give me support, strategic in terms of being able to make introductions, things of that nature. So that would have been all through 2020 when I kind of had the concept, tried to do some, capital raise. 2021, I would say, was when, okay, this is becoming real. So then, we work with US Bank and their Lift Series trusts. So we had to get board approval. So that took, that took about 6 months to get where we wanted to be, to have everything in line. We were shooting for, I'd say, a little bit more of summer launch. I thought being around the 4th of July would be kind of entertaining. But there's a lot of moving pieces, right? Nothing goes as smooth as you would think. So delayed it a little bit. We wanted to get out before 2022. And we thought we were in a good position, got board approval from US Bank, had, our seed investors kind of ready to roll when we hit the market, and got the fund launched on December 22nd, right before Christmas. It was a bad Santa.
Yeah.
Bad Santa Christmas. So,
that's awesome.
And that was good. The couple of the challenges, I pushed the envelope with marketing to some extent. And, that's one of those unforeseen things I didn't anticipate, right? Because let's just say regulators don't like sarcasm or some alternative marketing strategies by any means, which is fine. I totally respect that. You live and learn on those. It's, it was funny. They would always be like, Tommy, you can't do that. They're going to tell you no. I was like, okay, I get it.
That was going to be one of my questions is, not only did you have to get through your compliance department to tell you, okay, you can do this, which is a challenge enough. Now you have, you have a board on a trust at a trust you don't own, so you don't have too much control of the board. So you have all these, and then you have to deal with the distributor. So I'm sure you have, how many submissions do you have to put an ad in before they approve it, I guess is the question.
I've learned now where I can damn near get it without any kind of corrections.
Yeah.
But I would say the biggest one that we kept going back was, man, I wouldn't be surprised if it was around 10 or 15 resubmissions. So, I somehow got this, if people are looking, this DARE thing passed, which is bad in there, investing in betting alcohol and drugs.
That's right. The investing is important. People won't, people don't realize that. So we haven't had too many issues with distribution because our messaging is different, but I that to me was one of the biggest surprises of launch was how high, I knew it was going to be scrutinized, but really highly scrutinized. Down to like font size. And I think a lot of people don't realize that.
Yeah. Crazy. Yep. Right. They're like, okay, well, that's that size. I go, you want the disclosure to be as big as that? I go, that's going to take up half the page. So, we're just going to need a bigger page, I suppose.
So, staying kind of on track of how you got to market. So you launched in December. You decided to launch on the NYSE. You have other options. You have other alternatives. So kind of what drove that decision when you were picking exchange?
Yeah, I would say the people at the NYSE. I've got great relationships with them. Whenever I'm in town, I give my main contact over there him a call. And they're just realistic and they support the brand. On that side too, the pricing was fair, as well. And that's obviously a factor. And I think a lot of the support that they're able to offer you is, I'm not going to say superior to the NASDAQ, but I like just their overall brand a little bit more. Not to say I would never do business with the NASDAQ by any means. And, I'm sure they're quality people as well, but I do really respect the people at the NYSE.
That was one thing that surprised me when we launched with the NYSE is I went in there like nervous, almost like I don't belong at the New York Stock Exchange, and they ended up being like the nicest, most down to earth, fun people on the planet, and that was a pleasant surprise. So.
I agree. I need them to give me the opportunity to ring that bell, and I want to bring it. It'll be a party.
I was going to say the party after that might be. Can I come to that? By the way, I would love to come 100%. To the after party. Yeah, I would love 100%. That. So, you're not on your own trust. You're on UBS's trust.
US Bank.
US Bank. I'm sorry, US Bank's trust. So, when deciding whether you wanted to launch your own trust or join somebody else's, was that in your decision-making process? Did you go back and forth on that?
Yeah, absolutely. I think it ultimately came down to scalability. right? With you working with US Bank, there's a lot of things that go on behind the scenes in terms of accounting and filings and all the metrics that make an ETF work, the emails and the paper notifications that investors receive. That was, I needed to offload that work because at the end of the day, I want to focus on distribution. Not to say I still spend, in my opinion, too much time on some of that stuff, but it's a part of the job. And so, going through their US Series Trust, it also allowed us to kind of leverage some of the relationships that they currently had, like our authorized participants and the lead market makers, right? It gave us some credibility at the end of the day because, okay, we were able to pass the gauntlet of US Bank's board and everything like that. So, you guys are able to now, here's an introduction to this team. They would be a good fit for you. They're okay with the bad mentality. In fact, they embrace it. So, it came down to scalability and being able to kind of plug and play into their already fine-tuned processes, I would say.
Yeah. So now that you mentioned it, who are you using as your LLM, your lead market maker?
Our lead market maker is GTS.
Yeah, they're great too. We use them as well. So
yes, I couldn't have a better relationship with my contact over there. Great guy.
Yeah.
Enjoy talking with him too.
So before I lead into the next question, is it just you? Are you a one-man show behind this ETF or do you have a team?
Mostly. I have some team members as well that assist with a couple of things behind the scenes. But yes, I am basically a one-man show. I would love help if anyone out there is looking to get a little bad. We'll figure a way to get you compensated as we grow. But we would love a little bit of help for me to offload stuff so I can kind of get the creative marketing ideas flowing and focus on distribution, which is ultimately important.
Well, perfect. That was my next question. That's a heavy lift by yourself. So congratulations. I know, I have some help, which makes things a little bit easier, but it doesn't matter. It's still a heavy lift. So how are you approaching distribution? Is it purely just kind of social marketing or what's the idea behind distribution?
Yeah. So we did focus on, I think timing is everything. When we first launched, we were like, oh, wow, we're going to capture a lot of this retail crowd. Well, what happened in 2022. And unfortunately, retail investors, first ones to get out, last ones to come back in. So, we tried that. Social media, digital marketing stuff is pretty expensive. It becomes expensive. And it's hard to really capture I would say it's hard to capture your leads and how successful some of those digital advertisement campaigns are because as you and I both know, I don't know who bought the ticker BAD. I can't track that this person, went onto our website, saw it, and then went and bought it, right? We're not linked. No one's linked up like that. And then I, kind of pivoting, I was like, how do we get to our break even? Where do we get to that level? I would say in the fall, kind of pivoted to a more institutional advisor approach and getting our story out there. And I realized that we don't have the track record yet still to necessarily be given a shot in an asset allocation model, but I want to get our story out there and at least advisors will be able to explain that to someone else and their investors. And I always tell them, I go, I know we need a little bit of a track record. Our 1 year's coming up. We're having decent performance right now. But to keep an eye on us, I'm sure you have some investors that this appeals to. And so, whether it's throwing $10, $25, $30,000 on it, just put us on our radar, have this story, right? Story sell, working with a lot of advisors at Prime Capital and whatnot. I give them, here that people like this, we're in the Midwest. We're a little bit more, I would say, of a red state fund, to say the least, so we've got to embrace that. So focus on some of those areas, I would say too, and trying to get out there. So, right now I'm doing a lot of just bootstrapped approach, cold calling advisors, messaging them on LinkedIn, just trying to get our name out there in any capacity. You never know what's going to work, but it's rewarding when all of a sudden you see a big volume day come in periodically because it came from somewhere, right? And it's getting the name out there.
Yeah. I have an advisor I talked to last week in Vegas who I actually told him about your fund and he he was on the website. So maybe he'll throw you some volume here in the next couple of days.
I sure hope so.
Yeah. So you kind of touched on it there a little bit, as far as marketing goes, what do you think is working? What do you think is not working? Like, how are you playing with that right now?
Yeah, I would say it is passive marketing is not effective. It is having conversations is effective. Giving them a story of why they should invest, right? On the flip side, there's not too many asset managers that have us. Well, why not be the first, right? If you believe in betting alcohol and drugs as investment solutions for your clients, why not be ahead of there until you wait for someone else to jump in there? So I think giving people a story and being candid with it, like, yeah, we're not for everyone. I understand that, but we are for a lot of people as well. And there's no reason to hide behind the curtain. If it's in the best interest of your client, by all means, give us an opportunity, because I know these industries will be here 300, 400, 500 years from now.
Yeah. I've found the same thing, right? We tried to get a little cute in the beginning with, marketing, and the old fashioned way has really been the only way that we have seen success, which is just talking to advisors and telling them the story and building relationships. And it's really, it's a long game. And so I think you're on the right path there for sure. So, I've seen you do some media. I saw you on FinTech TV.
Thank you.
How are you? Is that something new for you? And how are you handling the camera?
Yeah. We started it early on. When we first launched, TD Ameritrade asked me to come on our launch day. I had a little bit of media training. We were working with a PR firm, and I'll be honest, I was nervous. I was excited. And then as time goes on, we scaled up, and I'm comfortable doing it. It makes me, I'd say, even better public speaker when I'm out there. I was able to go on Bloomberg one day, and what an experience that was, to kind of go in there. If you ever seen the show Westworld, when you walk in there, you have like a host that just walks up to you and they're like, "Hey, Mr. Mancuso, go do this." And then they sit you down in a chair. They're like, "You want some makeup?" And then you're like, "I don't know. Do I need it?"
Right. Yeah.
Like, your hair, I'm just going to do one thing to it. I was like, "Okay, that's fine.
Do whatever you want." Yeah. That's
yeah. And so I think it's what I realized over time. I think I've become less scripted. I'll go in there. I'm like, "Hey, what do I need to do?" I even emailed you like, "Hey, is there any outline to this?" Or we're going off the cuff. I'm totally good with that, which I think is best because it's such a more candid conversation to have and being natural. Right. At first I was like, "Oh, I got to dance around us being these, the bad investment company." It's like, own it. We are who we are. We believe in the strategy at the end of the day. So, I like media now. I'm not I dislike them. Well, certain factors of it, but it's good. I'm comfortable with it. It's a good thing, and I think it's good to get your name out there too.
Yeah, I think media is. It gives you, I think, immediate credibility. One thing that's hard for me with media is everything we do. And even in your case, right? Like everything you're doing is passive and rules based. Everything we do is passive and rules based. And one of the reasons why we started the show is to be able to have candid conversations that might fit our story a little bit more. And they'll be like, "So what do you think about Apple's earnings?" I have no idea. So I just have to start being like, I can't answer that question. I don't know. It doesn't affect my investment strategy. I can't answer that.
Yeah. We'd like Apple in the portfolio. Yeah. It's worked for the past 20 years. So.
Right. So, last couple of questions here. Being a single issuer, what is one thing that kind of has been a frustration for you?
Yeah, I wish where someone says that, okay, you only have this one box. I wish we had another product we could offer them, with having, okay, I've got a Rolodex, right? That's something that, talking to other wholesalers in the ETF world, they've got a solution for everything, right? Because their companies are massive and they have that thematic. They have that one. If that's not a good fit for you, what are you looking for? Right now, I'm trying to fit BAD into some squares, right? If it's a circle, I'm trying to fit it into some squares. So finding those circles that we fit into is a challenge, I would say, being a single ETF issuer, right? That's, I'd say, the biggest challenge is with just one fund.
Well, even with that being said, if you're going through relative underperformance for whatever reason, you can't pull something else out of your bag and do the, hey, look over here, and kind of keep the assets on firm. And that can be frustrating. And so if you have any, who are your competitors in the space? Are there any competitors to the BAD ETF?
I would say our competitors maybe would be like the BETS ETF by the Roundhill guys. They've got a lot. Some of the cannabis companies, we get looped into the cannabis conversation quite a bit. And, if you look at that, we have destroyed the cannabis industry. When I talk about that, I go, well, if you're looking for cannabis exposure, we're your best proxy for that, because not only do we have a direct investment in there, we have indirect investment through the alcohol companies who are helping, Constellation has investment when those, and the drug companies too have investment because they're losing market shares with sleep medications and things of that nature to the cannabis. And so they're going to be able to kind of, when cannabis goes legal, they'll actually capture some of that too. So if people are waiting and they want to wait, and they're a cannabis play, I would say look at us on that side of things because we're a great proxy for that area. So, other competitors, right? We're not going to be able to just keep up with a pure play pharmaceutical type of play. That's not us. I like to call us the three-headed dragon. We're unique, right? There's very few investments out there, ETFs, that are just limited to 3 different sectors and that alone. So, it's unique because, maybe I want direct exposure. Maybe I want this. Well, if you were to go on direct exposure with either betting or cannabis or some of that stuff last year, you would have underperformed significantly. On the other side, right? Pharmaceuticals did great last year. So again, we're kind of a blend of a lot of ETFs combined, where take out the guesswork to some extent. You want to be in these industries. We're going to give you hopefully a little bit better of a risk-adjusted return at the end of the day.
Yeah, that's great. So final question here, Tommy, and this was a great conversation. I'm so happy to have you on here.
Episode 1.
Yeah. So where can people and how can people learn more about you and the BAD ETF and your product and your offerings?
Yeah. So go to our website. Is going to be the number one spot. You can type in investbad.com or badinvestmentco.com. They'll direct you to both of those. There's an info email out there, info@investbad.com, that will get sent to us and we'll get to you at some point. I'm available on LinkedIn. I'm active on there. Encourage people to reach out if they want to hear the story or have more questions about the fund itself. I'm happy to provide that insight on there. So investbad.com or go find me on LinkedIn.
All right. Well, that's how I found you. Yeah, that's how I found you. I get so frustrated with LinkedIn with all of the messages. And when we decided to do this, I'm like, the best way for me to get these people on LinkedIn, and now I'm going to have to message them. The one thing I hate more than anything in the world is getting a random LinkedIn message. So.
Oh yeah. Well, the worst are the ones that are not even related to your business. You're like, if I'm trying to find someone, I'm like, I know they're in the investment world. I know they're an advisor. When I get some kind of email about, hey, here, do you need new health insurance for your? I'm like, no, I don't need that.
Yeah. Yeah, there's so many of those LinkedIn automations out there. People are just, and then you'll get the follow-ups where it's, can I? When's a good time? And they just keep hitting you and over and over again and spamming you. But
I like messing with them sometimes. That's a good way to kind of counter that.
After a few cocktails, Tommy, I do. I'm supporting your fund indirectly. I'm known to send a snappy one back a time or two. I do get a laugh out of it. I shouldn't, but it is fun.
I love it. That's great.
Tommy, again, thank you so much for joining us. And I look forward to hopefully one day running into you in person. And don't forget to invite me to the after party of your bell ringing, okay?
Absolutely, Brad. No, thank you so much for having me on here. I thought this has been a fun conversation, so I appreciate it.
Thank you.